Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Wednesday everybody. Let's begin today with our ongoing coverage of the slow-moving housing crisis. And as we will see soon, things are starting to look quite disturbing in some localities. We have two sets of data to look at today, and the first is from China Index Academy, which covers home sales during the Golden Week holiday last week, usually a popular home buying time. According to the Academy's report, new home sales fell over 37% during the holiday period year on year. Among 20 cities monitored by the China Index Academy, the average daily floor area of homes sold in 4 Tier 1 cities all fell sharply from last year's holiday season, with declines of 64% in Beijing, 49% in Shenzhen, and 47% in Shanghai. The sharpest fall was in the eastern city of Hangzhou, declining 80% year on year. However, we should note that sales of existing homes did fare somewhat better than new homes across the country. The second report is from the Shanghai E-House Real Estate Research Institute, published this week, which looks at home prices at the city level. Among 50 cities tracked by Shanghai E-House, housing prices in only 4 have returned to growth: Chengdu, Beijing, Shanghai, and Hefei. In the 46 other cities, price declines have extended past 12 months. The decline has been particularly acute in several urban centers. For example, housing prices in our old friend Zhengzhou, capital city of Henan province, fell for 46 months, with the average price plunging 9.6%. So we can see here that despite hundreds of policy moves to roll back previous property controls from local governments, there has been little sign of recovery in the wider market. And as we start to look closer at what some local governments are doing to revive demand, some measures are quite disquieting. For example, according to real estate information agency Real Estate Information Corp, new home transactions in downtown Suzhou in eastern China's wealthy Jiangsu province doubled in September, an impressive performance, all things considered, attributed to government policies to, quote, boost consumer confidence, end quote. But as we look a little closer at the details of this performance, things are not exactly as they would seem. Chinese financial outlet Yicai writes that the best-selling project in this area, quote, with 526 homes sold, included about 400 units purchased by the local government, end quote. It writes too that, quote, 2 other major projects located in the Suzhou New District also indicated that a large part of the sales was purchased by the government, end quote. This is quite concerning, and analysts have not been shy in expressing this. Quote, this strikes me as a little strange. Sales have doubled mainly because the government is buying a huge number of apartments. This is good news for the developers, no doubt, but it means that the Suzhou government is becoming the biggest speculator of all in its own real estate market. This doesn't make it easier to figure out what is really happening to the property markets, end quote. Next up, party mouthpiece The People's Daily has published its second commentary this week, explaining why zero COVID policy is best for China. For those hoping for the relaxation of the disruptive and controversial policy after the 20th Party Congress, these two authoritative commentaries will be dampening hopes. Indeed, commentators and analysts are increasingly pessimistic on this front. Quote, the chances for a material shift in the dynamic zero-COVID policy soon after the 20th Party Congress seem increasingly minuscule. There has been a rumor going around, at least in finance circles, that Beijing is planning to drop quarantine for all international arrivals in December. This seems hard to square with this messaging, the spread of new variants globally, and the vaccination and immunity gaps in China. Caixin reports that Shanghai district governments are now hiring for epidemic prevention and control workers with a contract term of 2 years, end quote. Here is some of the second commentary from state-run People's Daily. Quote, fighting against the epidemic is both a material struggle and a spiritual confrontation. It is a contest of strength and a contest of will. we will not waver in adhering to the general strategy of external prevention of importation and internal prevention of rebound, and the general policy of dynamic zero COVID. This is not only the basic requirement of adhering to the scientific spirit and attitude, but also the inevitable choice of following scientific laws and protecting the fundamental interests of the people." End quote. Hey everyone, if you enjoyed today's episode of China Update, don't forget to hit the like button. And as always, anyone who wants to go the extra mile and help me keep this channel sustainable, this is a tremendously important part of me being able to do these every day. Patreon and Buy Me a Coffee links are in the description below. Thank you so much everybody for the ongoing support. Finally, let's continue with our coverage of fresh US technology, specifically semiconductor restrictions against China, the export curbs which will likely fuel a knock-on impact across the entire global chip sector supply chain, roiled global markets this week. The new restrictions sparked a sell-off in chip-related stocks that has wiped out more than $240 billion from the sector's market value around the world. The Philadelphia Stock Exchange Semiconductor Index saw a two-day rout of over 9% this week. Taiwan Semiconductor Manufacturing Co. plunged more than 7% in trading yesterday. Samsung Electronics Co. saw its worst daily performance so far this year too. Even South Korean and Taiwan currencies dropped against the US dollar, retreating 0.6% and 0.7% respectively in trading yesterday. Now, it's worth reminding ourselves what exactly the US did with this new round of export restrictions. Quote, "There are four interlocking elements of this new policy targeting different segments of the semiconductor value chain, and all elements must be understood simultaneously to grasp the scope of what the Biden administration plans on achieving. In short, the Biden administration is trying to 1. Strangle the Chinese AI industry by choking off access to high-end AI chips, 2. Block China from designing AI chips domestically by choking off China's access to US-made chip design software, 3. Block China from manufacturing advanced chips by choking off access to US-built semiconductor manufacturing equipment, and 4. Block China from domestically producing semiconductor manufacturing equipment by choking off access to US-built components." End quote. The full and long-term implications of these US restrictions are still being debated, and they are certainly making waves in East Asia. Quote, "The latest US move would prompt China to move faster in fostering the domestic chip industry. Japanese firms should continue trading with Chinese firms with goods not restricted, because the business is business. But they should be ready for a future, maybe in a decade or two, when they lose all the Chinese customers as a result of the current tension, dialing up speed of the Chinese efforts." End quote. And, quote, "With the latest measure, it would become difficult for China to manufacture and develop semiconductors because most semiconductor equipment are dominated by US and its allies. It is impossible to maintain the chip industry without adopting advanced equipment." End quote. And finally, simply, quote, "The US restrictions are a big setback to China and bad news for global semiconductors. China's localization efforts may be at risk, as it may not be able to use advanced foundries in Taiwan and Korea." End quote. Okay, that is today's episode of China Update. Thank you so much everybody for watching. I'll see you all tomorrow.